The older you get, the more you know, which obviously means the less mistakes that you make. That's funny. You're smart, but you're also pretty dumb. And it's not just you though, I'm a pretty big idiot as well. Case in point, I still fall every now and again when I'm walking up the freaking stairs. Seriously though, how does that even happen? I'm like a small child. But whether you've been investing for 20 minutes or 20 years, mistakes will be made and thousands of dollars is gonna be lost. So to help save you a ton of cash and a lot of headache, I'm gonna go through some of the biggest investing mistakes that you could make within the next 20 years that could cost you tens of thousands or even hundreds of thousands of dollars. The money lost is basically the difference between you being able to quit your job in 10 years as opposed to 20. So think of this like saving you 10 years in under 20 minutes. All I ask for in return for saving you time and money is just a little tap on that thumbs up button, maybe a little comment down below to say hi or tell me how you're doing. You're the biggest reason that you'll make a huge mistake when it comes to investing money. Not because you're a moron, but because you're human and act more on emotion than logic. Humans are insanely irrational and do really dumb things with money that's invested because emotion gets in the way of smart decisions. As much as I like to trash on them, this is one of the main reasons that hiring a financial advisor can be beneficial for some from an investment return perspective. They're not the best at picking investments for you. They're actually really bad at it, but they're good at talking you off the ledge when the market is crashing and all you want to do is sell off your investments. Investing is very binary in the sense that you either make money or you lose money. There is no in between. You can't kind of make money and you can't kind of lose money. A simple way to win is to buy and hold index funds with the mindset of never selling and always remembering that losses on paper are different from actual losses in your investment account. Both of my sisters are probably the best investors that I know. I could ask them every single day for a year how their investments are doing and they'd have no clue because they don't give a shit. The decision to buy and hold the index funds that I put them into are going to make them better off than 95% of people who check their accounts on a weekly basis and make adjustments. Now, I made that percentage up, but it's a lot, so you get the idea. While I like to kind of consider myself an unemotional robot when it comes to investing, it still stings a little bit for me when I see my account go down in value, but only when I invest in individual stocks. A solution is to take note of how you react when the stock market goes up and down. If you go off the rails when your portfolio is down, then you might want to change the asset allocation because your emotions obviously can't handle how the money is currently invested. You also might not want to, look at your investments 8 times per day. That is the best way to stay the course. But if changing your allocation will lower the expected returns, then that is just unacceptable, right? When we invest, we want to get the highest returns possible so that our money can grow at the fastest rate possible. But it's not that simple. Investing to maximize your returns is kind of a double-edged sword. When you invest money for high returns, you are automatically taking on more risk. This isn't necessarily a bad thing, but if you can't stomach the potential losses that go along with the riskier investments, then it's probably better to accept less risk and a lower return. Don't always try to focus on the highest returns possible. You need to match your investment risk with your emotions. If you have a very high risk tolerance, then you could probably handle some of the more risky investments, kind of like an ARK ETF. On the other hand though, you're better off accepting a lower return on investment if you're going to sleep a lot better at night. Someone investing 100% of their money into 20 different stocks is taking a bigger risk than someone investing 100% of their money into something like index funds. While the person investing most of their money into those 20 stocks might see a higher return, they're still concentrating a lot of money into a smaller number of stocks, which might be considered more risky. I know that 20 stocks probably sounds like a lot to the average person, but in the grand scheme of stocks available to be traded, it's not very many at all, which means that you have to be right about those 20 stocks being successful compared to someone like me who invests in the Vanguard Total Stock Market Index Fund, which holds over 3,600 different stocks. For me, way more than 20 of those 3,600 different stocks can be losers and I'll be just fine. Now keep in mind that because I'm taking less risk by investing in something like a VTI, I'm also accepting an average return, which I am perfectly fine with. So you should understand your risk tolerance tolerance, emotional state, and invest accordingly. It's going to change over time as well, so don't be afraid to kind of switch up your strategy as you age, different life events arise, or you become more educated about investing in general. The investor that you are today is probably going to be quite different from the one that you are over the next 20 years. There is no shame with switching up a strategy if the current one that you are using right now isn't working for you. That's one of the reasons that I've changed my mind when it comes to judging a lot of the ways that people invest. We are all doing different things based on different goals, and what works for you doesn't necessarily work for everyone else. Nowadays, I see so many stock picking YouTube channels popping up that it absolutely blows my mind. The views that they get from talking about a few popular stocks makes my head absolutely explode, and each of them have their own different ways of investing and looking at particular investments as well. And let's be honest, most of the time it's not based on any numbers or realistic projections. They're just reading a news story and telling you to buy a stock. They're easy to find, but no names please. Hype stock investing, penny stock investing, growth stock investing, value investing, dividend investing, swing trading, momentum trading, social arbitrage investing, options trading, day trading, chart trading, investing in SPACs, investing in IPOs, investing in what that guy on YouTube told you to. Did I get them all? Probably not, because there's a lot more. I'll be honest, it used to annoy me more than people who release a clickbaity stock market crash, crypto crash, or housing crash video every single week. Once again, no names please. But now I look at it as a way of investing that works for that content creator and those viewers, and that's okay. No matter how dumb I think it is their money and they can choose how they want to lose it. Not my monkeys, not my circus. I actually think that taking a portion of your overall invested money and earmarking it as quote-unquote play money can be pretty beneficial. Look, I don't think that anyone is going to argue about the benefits of long-term investing. But if setting aside something like 10% of your money would scratch that stock market gambling itch that you have and allow you to keep your dirty, grubby little fingers off of those long-term investments, then I'd say start shoving those hands in mud, go visit that Wall Street Bet subreddit, and start spinning that roulette wheel. Now, it is worth it to be just a little bit skeptical when listening to other people's thoughts on investing in particular ways, but I'm all for gathering info from many different sources, then making your own educated decision. Let's be honest, it's not difficult to talk anyone into investing a certain way or into a certain company. Heck, if you gave me a stock, a really bad stock, and enough time, then I 100% guarantee that I can make a solid case as to why you should invest a ton of your money into that company. Even if it's tanking right now, I can talk you into it. I'm extremely biased towards index fund investing, but don't just copy me or listen to me because I talk about it in a positive light. Go look into it on your own, pick it apart, and understand the bull and bear case to see whether or not it makes sense for you. There's a reason why I've created a video on the downsides of index fund investing, even though I'm 100% all in on it, because I think that it's always important to challenge your own beliefs and take an objective look at the opposing views. But whether you choose to invest in index funds or individual stocks, trying to time the market is usually a loser's game. I promise you're going to make yourself go crazy by waiting for that perfect price to hit that buy button. I'll admit that I've had trouble with this in the past. I have the cash to invest, but I just want to wait for that perfect price. I think in my head, oh, just a little bit lower and I'll buy some shares of that index fund. I've told the story before where I had a friend that sat on $30,000 in cash for a little over a year because he was waiting for the stock market to sell off before investing the money. He was listening to a lot of those stock market crash videos. The market, of course, never did, and he missed out on over $18,000 in return during that time period, even though Uncle Jarrad over here kept telling him to just invest the money and forget about it. We don't know if the market is going to go up or down within the next 12 months, but if you are investing in something like an S&P 500 index fund for the long term, so like 5+ years, then there's about a 75% chance it's going to be higher than it is today. The price you pay today is way less important than you think. A couple weeks ago, I had a few $1,000s sitting around that I was planning on dollar cost averaging into a specific investment account between now and the end of the year. Then I said to myself, well, if I technically don't need this money for another 10 years and I have the money on hand, then Why not just put it all in now? Sometimes I even need to take my own advice, so I decided to practice what I preach. Now the money is invested and I feel really good about that decision that I made. The money is exactly where it was going to end up anyways, and it's one less thing that I have to spend time thinking about. If you're investing for the long term, then don't wait. Get that money invested so it can start working for you through the growth in the stock price and the recurring dividend payments. Investing can be difficult if you don't know what to look for when deciding what to invest in. So you'd think that the best way to choose where to put your money is by looking at the past performance, right? No, and heck no. I remember back when I first learned about investing, I would automatically sort on the mutual funds with the highest performance over the past 5 to 10 years to decide where to put my money. Because my natural thought was that if they had done really well during that time period, then surely they'd perform at the same rate, if not better, going forward. Hindsight is always 20/20. Just because the ARK flagship ETF has grown by more than 400 or 500% over the past 5 years doesn't mean it's going to grow at the same rate or even close to it over the next 5 to 10 years. This is even more true when we're talking about actively managed funds like any of the ARK ETFs. Now, just a disclaimer, I'm not trying to pick on them specifically, but they are the hottest ETF management company that most people are aware of right now. Choosing what you invest in shouldn't be 100% based on past performance. Yes, you should take note of it and use it as one data point, but don't make that the only reason that you choose to park your money there. We have to always remember that the stock market is based on future expectations, not past performance. General Electric stock did really well for a good 15 years. They were a top-notch, publicly traded company for a long period of time, just like some of the ones that we hear about today. And if you had invested in the stock expecting it to continue to climb, then you'd be down quite a bit of money today. If you're investing in an individual stock, then understand where the company is today and where they expect to go in the future. Don't just look at the bull case of it though, because as I said before, anyone can put lipstick on a pig to make it look good. Understand the bear case for why it wouldn't make sense to buy the stock, then make your decision. When it comes to funds like mutual funds, index funds, and ETFs, understand the underlying investments within those funds. What's the percentage breakdown of large cap, mid cap, and small cap companies? Is it an actively managed fund or not? How much cash does it hold? What are the fees? What industry is it tracking? There's a lot more questions that need to be answered about the future of that investment as opposed to just the surface level ones like past performance. The best way to think about it is to treat your investment choices like you're going to marry these freaking things. You need to spend the time to understand each one before heading to that hypothetical chapel to get hitched, because divorce costs a lot of money, and so does selling your investments for a loss. Since we're on the topic of investing for the long term, we should probably touch on the P word that no one likes to say. No, not that one, you weirdos. Patience. Everyone wants to become rich through investing overnight. And if you listen to enough of the scammy YouTube videos or YouTube ads, then you probably think that it was possible. There's a reason why I get more and more questions about investing in things that see huge price spikes like Dogcoin or GameStop stock, because it's viewed as a way to get rich quick. Dogcoin increased in value by something like 500% in 1 week. So should you invest in it now? No. Not unless you have some extra cash sitting around that you want to speculate with and you're okay with essentially disappearing. Talk to anyone who is truly wealthy and they'll tell you that it took a lot of time, energy, and hard work, especially at first. There will come a point where the work done on the front end starts to pay off on the back end, but it's very rare that it all happens in the beginning. Yes, you can earn some quick cash on a speculative investment, but in the overall grand scheme of your investing lifetime, those quick speculative investments aren't going to make you truly wealthy. I threw $1,000 into GameStop in January of 2020 and ended up turning that into $3,000 before selling out of it. Now, the profit that I took from that one trade isn't going to make me rich over the long run, but it was kind of a fun way to gamble with some extra cash that I had lying around. Investing to become wealthy is like chopping down a tree. You have to take enough swings on a consistent basis for it to eventually fall over. The first, 5th, 10th, or even 20th swing won't knock down the tree, but on the 21st swing, the tree will come crashing down to the ground. But it wasn't because of the last swing. it was because all of the swings that you had taken before that point in time. If all you're doing is taking a short-term view with how you are investing, then you'll essentially be swinging at that tree and constantly missing the tree completely every single time. Instead, you need to take focused, intentional swings over a long period of time to ensure that you make contact with that tree every single time. Don't forget to Hulk smash that thumbs up button before you go. In the description, I'll have a link to get on the waiting list for our private financial independence group that's going to be opening soon. Down there, you'll also find free stocks, resources, and playlists to help out with your financial independence and investing needs. Watch these videos to your left next. I'll see you in the next one, friends. Done.